This is Bill Even, your CEO here at the National Pork Board, coming to you live from Interstate 29, somewhere south of Sioux City, Iowa. We're headed up to our farm with our family for Christmas. I want to wish all of you a very Merry Christmas and a Happy New Year as we kick off this National Pork Board December 2021 USDA Hogs and Pigs Report. Today, we're want to make sure that we're giving you some good information from folks that you know and trust. First off, we're going to have Dr. Steve Meyer from Partners with Production Agriculture. Steve's going to run through the numbers from the USDA. Then we're going to kick it over to Bob Brown, who's going to start off with our commentary. And then Dr. Ron Plain from the University of Missouri, and then wrapping up with David Miller with Decision Innovation Solutions as our panelists today. And again, at the end, as always, we do have a Q&A session planned for the end. So feel free to enter questions into the chat, and Jared Sutton at the National Pork Board will help moderate the chat. As we get started, we're going to cover off on the antitrust statement. Of course, the National Pork Board and all the folks involved take the antitrust laws of the United States very seriously. We want to make sure that there's nothing that is spoken about on this call in form of questions or answers that could perhaps violate the antitrust laws of the United States. And then just a reminder that pork checkoff funds are being used to host this webinar to facilitate your understanding of publicly available USDA information. We believe that the pork industry and ultimately consumers will benefit from a better understanding of the economics of pork production. And again, the views expressed on this webinar are those of our guest speakers and not those of the National Pork Board, which does not advocate or endorse any particular production or marketing direction. So with that, I think we'll turn it over to Dr. Steve Meyer with Partners for Production Agriculture to run through the numbers. Steve, take it away.
Thanks, Bill. Bill's in I-29 and I'm sitting near Stillwater, Oklahoma. What a wonderful world we live in. It is good to be with you, everyone, and Merry Christmas to everyone. We hope 2022 is a great year. We're going to start it off here with the Hogs and Pigs report from USDA, and you see in front of you a table that shows last year's figures, this year's figures, percentage this year of last year, and then a column of pre-report estimates that were published last week by Erner Berry, and then a difference column over there, which is the actual percentage of the last year minus the pre-report estimates. So let's go through the numbers. We'll talk just a little bit about those differences as we go through. All hogs and pigs, 74.201 million head. That's down 4% from a year ago. The analysts expected that number to be down about 2.8%. So a little over 1% difference on that number relative to pre-report expectations. The breeding herd, 6.18 million, 0.1% larger than last year. That's what the analysts expected it to be, so no difference there. Market hogs, 68.021 million, down 4.4%. Analysts thought that number would be down 2.9%. So again, a difference. I wouldn't call it significant, but certainly a difference of 1.5%. Under 50 pounds, 21.174 million head, down 3.7. Analysts had thought that number would be down 2.9. 50 to 119 million, 19.15 million, down 2.5%. Very close to what analysts expected. Some differences in the heavyweight categories from pre-report expectations. 14.809 million on the 120 to 179 pigs. That's down 6.2, and analysts had thought that would be down 3.8. So a pretty significant difference on that one. 180 and over, down 12.857 million, down 6%. Analysts had thought that number was down 3, would be down 3. Just of note, if you look at actual slaughter, total of daily slaughter on an equal number of weekdays and Saturdays this year versus a year ago, that number was down 5.4%. So not too far off from where the 180 and over was. On farrowings, 3.012 million litters in September-November quarter, down 4.8. Analysts had thought that number would be down 3.1. So another number that's significantly lower than what was expected. DSFEB intentions at 2.943 million, up 0.5%, very close to pre-report estimates. And then finally, March-May intentions at 3.01 million, down 0.8%. Analysts had thought that number would be up a bit. September-November pig crop at 33.712 million head. That's 3.6% lower than a year ago, and analysts had thought that number would be down about 2.7. So close to 1% difference there. And finally, a pretty healthy increase in pigs saved per litter, 11.19, up 1.3%. Analysts had thought that number would be up 0.5%. If we'll go to the next slide, Claire, we'll just show this for a moment here. This is just a picture put together by Cody Good on our staff at Partners for Production Ag. You can see the average of the estimates are the blue squares, the range of the estimates are the gray bars, and the actual numbers are the orange. And in this case, of course, market hogs and all pigs are below the low of the range. The same is true of the 120 to 179s and 180 and over, a significant lower number than where the range was on that one. The same for farrowings. The other numbers were somewhere in there. And then you can see down at the bottom, pigs saved per litter, a significant, it's way above the top end of the range of estimates for that figure. So I think a pretty good picture of what the report was, one we use quite a bit. So I hope it's helpful to you. Claire, those are the numbers, and we'll pitch it over to the analysts to find out what they mean.
The first thing you notice if you open the USDA hogs and pigs, there was a box at the top of the report that said, oh, we had to revise some data. So actually they revised clear back to 2019. So I'll just run through those. The December 1 inventory from 2019, so from 2 years ago, was revised downward 1.4 million head. The March 1 inventory from 2020 was revised down 1 million head. I'll just give you the highlights here. The June 1, 2021 report was revised down 1,250,000. So that's that likely was a March. That was a March-May. Part of that was a March-May pig crop revision down 350,000 head. So again, the reason USDA does this is to try to true up to what hog slaughter was and to what the current survey showed them. So those are two of the criteria that they're looking at when they make revisions like this. But as we all know, 2020 was not a normal year by any stretch, especially the April-June period when we had a lot of downtime. April-June of 2020, we had a lot of downtime in the slaughter plants, which messed up, trying to compare pig crops and slaughter. And so they're just doing their best to try to keep this data trued up to what we had. And like Steve said, recent slaughter's been down about 5%. So again, that's kind of the latest litmus test that we have to work on. So don't know that this will mean a lot to the market, except that, some of our percentage changes, which the market likes to look at a lot, some of our percentage changes comparisons to a year ago will be affected by when they go back and revise last year's data. It'll make that look. So again, it's really helpful to look at the actual raw data most of the time anyway. So that's all I have on the revisions.
Thank you, Bob. We'll turn it over to Dr. Ron Plain for his comments. Ron?
Good afternoon. This is a positive pig report in my estimation, and one of the reasons is market hog inventory, which I want to talk about, is smaller. Not only is smaller than a year ago, but well smaller than trade expectations. USDA said market hogs numbers were down 4.4% on the first day of December. Basically, this is hog slaughter for the next 6 months. December through June should be pretty well alive and on farms at this time. So down 4.4% in market hog numbers. That's also 1.5% smaller than the trade was expecting. So not a whole lot of hogs out there. And with respect to what it means for prices, when you have fewer hogs than the trade was guessing, there's a good chance we may see some upward movement in lean hog futures when they open next. By weight groups, the heavyweight groups on 180 pounds and up on December 1, we've slaughtered most of those. We'll finish them up in another week or so. USDA says down 6% compared to a year ago, and it's 3% smaller than the survey of trade quasi-experts that came up with. So that's a very bullish number. The next weight down, the 120 to 179 group, down 6.2% relative to a year ago, down 2.4% relative to trade expectations. Again, positive number implications for hog prices and that. The next group down, the 50 to 119 group, up slightly compared to trade expectations, but still down 2.5% compared to a year ago. And then the lightweight pigs, basically those born in the last 3 months, September, October, November, down 3.7% on the first day of December, and that's down 0.8% compared to what the trade was forecasting. So in general, tight supply of hogs for the next 5 months, and likely some pretty good prices for hog producers as a result of that. One other thing I might comment on, Steve talked a bit about it, alluded to it in his review of the numbers, is that pigs per litter was up 1.3% this quarter, the September, October, November quarter. That's the biggest increase since December, January, February of 19. So productivity, which was strong for a number of years in the mid-teens, adding almost very consistently 1% more pigs to the pig crop just because of more pigs per litter, has for the last several years has been averaging close to zero. So up 1.3% is a pretty hefty increase in productivity. If that continues to carry forward in subsequent fairing periods, once again, it may add more pigs to the hog supply, just without having to have more sows if pigs per litter keeps going up. I'm done.
Ron, thank you. Thanks. He's coming to us from the closet of his sons in Missouri. So we're glad you're home and ready for Christmas. You're not done yet, just for these comments. We'll move over to David Miller. Dave, take it away.
Oh, thank you. Going to talk a little bit about the breeding herd and the expectations there. The breeding herd came in at 100% of a year ago. But if we dig down a little deeper, that's 97% in Iowa, and Iowa was 97% a year ago. So that's 2 years in a row the December breeding herd in Iowa has been down. Illinois is a little different story. Last year they were down 3% at 97%. And this year they're up 7%. So you've got a rebound going on. Trying to dig into the data a little bit and see if some of the responses had to do with correlations to where plants had some of the most problems in 2020 with regard to hog movement and hog processing. But it's probably not consistent. Indiana was 100% a year ago on the December breeding report. This year, they're down they're up 4%. And Minnesota was down 5% a year ago. They're up 2% this year. Nebraska down 2% a year ago, up 7% this year. South Dakota was up last year 2%, and they're down 2% this year. And North Carolina is kind of like Iowa in that they were down 7% a year ago, and they're down another 4% this year. And so you've got probably the two biggest states with regard to breeding herd, Iowa and North Carolina having 2 consecutive years of declining breeding herd. But you've got the second tier of states, the Illinois, Indiana, Minnesota, Nebraskas, that all are showing increases this year. And one of the questions that's in my mind is, are those states kind of leading where we're going to, with either response to capacity coming back up towards normal and overreactions at times. Oklahoma was also at 100% of a year ago. So you've got that second level of states all showing increases in the breeding herd, which I think portends that maybe by the second half of 2022, it would not surprise me with the trend on the pigs per litter and maybe some expansion being started in the breeding herd retention, that we may see second half numbers higher than maybe what the current USDA estimates are. When we look at, so it could be this tale of a kind of a switch, that the near-term report was definitely positive towards hog prices against expectations, and we're likely to get some strength. That probably leads and feeds into some additional breeding hog expansion as we go into the spring and into summer. And so the second half of the year could see supplies up stronger than what we maybe are expecting right now. So maybe it's positive for the first half of the year and maybe a little bit balanced or potentially negative for the second half. That all depends probably on what happens to total demand and what's happening with return to restaurants and a return to demand. I'll stop there for now.
Dave, thank you for your comments, and thanks all of you for providing those opening comments. Hey, the first question that I've got for you is what's the thing that surprised you the most in this report? And Bob, we'll start with you.
Given what I think the profitability was, running up to the report in the first half of the year, especially even with the run up in feed prices, I was not really surprised by anything. I think, again, seeing slaughter down 5%, the heavyweight market hogs were down 6%, so I think that's pretty much in line. Again, looking at profitability, I think that we can, think that the production industry is looking out forward, even given the futures prices on corn and hogs, and looking at profits. And I think they're turning the pig crop, turning the breeding herd around, which will get some pig crop increases going. Probably seen increased numbers in the last half of 2022. So I wasn't terribly surprised by this report.
Makes good sense, Bob. Ron, what surprised you?
Surprised a bit by the market hog inventories that I talked about. They came in lower than 1.5% smaller than trade expectations. They were 2% smaller than my attempt at trying to predict what USDA was going to say. The profits during 2021 was very good. It's I think going to work out to be about the most profitable year since 2014. So I was looking for a little less of reduction in fairings and more of a sizable, larger pig crop and market hog inventory for this period than we ended up with. So that's what surprised me the most.
Good, thank you, Ron. Dave.
My surprise was probably the Iowa breeding herd. I probably expected it to be more in line with Illinois, Indiana, Nebraska, all that showed positive growth on the breeding herd compared to a year ago, and yet Iowa came in a little bit negative. That may be reflective of the hot, dry weather and the concern about corn availability through the summer, even though Iowa ended up with a very, very good corn crop at the end of the year. I think when we were before harvest, we were definitely looking at maybe locally much higher corn prices in the heavier hog production areas of Iowa. And so that may be why it occurred that way, but yet I was probably a little surprised given that we did come through with a very, very good corn crop and really didn't see that reduction in the breeding herd in Iowa coming on that way.
Right, thank you, Dave, and what a crop it was for sure. So next question we've got is, what is the break-even cost of production for the next quarter? Bob, we'll start with you again.
Okay, break-even cost is something that I leave the experts to do, so I will defer to, if you give me just a second. I happen to have a little spreadsheet here from our friends at Iowa State when they calculate it, and I'm gonna, if I can find it here quickly.
That's
If you
gonna
have
make,
another one, I'll come back to me. I
Yeah,
can,
well,
unless somebody else has a number. Ron, maybe you have a number.
I know that's going to make all the Cyclone fans happy that you're looking there for the answers. Ron, what do they say in
Absolutely.
Missouri?
Well, I was looking, I don't calculate the numbers. I use Iowa State's numbers on this. I think we're looking at somewhere around a break-even price, $80 per 100 pounds of carcass.
Yeah, that's what the latest data shows from Iowa State.
The next several months, and then hopefully a good corn crop this coming summer and lower break-evens in the second half of 2022.
Good. Great.
Now, the one thing we might be overlooking is the credit for manure, given the recent run up in nitrogen costs. Oh my gosh, wouldn't people pay a fortune for manure this coming year?
I think you raise a good point there, Bob, that the manure credit, particularly in those areas like Iowa, where you've got a full utilization of that manure going back onto corn ground, that manure credit's definitely going to have value. And given where nitrogen prices are, the manure's worth double to triple what it was a year ago. And that is not an insignificant value that's probably left out of the calculations.
I usually don't interject myself on these discussions, but I have a model based on the Iowa State parameters that uses futures out into the future to predict cost of production. This year, that cost number is going to average right at $80, it looks like. And next year, given corn and soybean meal futures as of last Friday, it's going to be about $78 on the Iowa State estimates. Our experience is that number is a little low relative to the average producer. We think it represents pretty good producers. So, so that this number around 80, 82, 83 is pretty good, I think, for the future. One point, David, I will make is a lot of the people that get the manure credits are not the people that own the hogs. They're the guy that owns the finishing building. Okay. Right. So I don't think manure credits figure back into a lot of these hogs that are fed in the ones that are fed in contract barns. It doesn't figure into any of them. The guy with the barn gets the manure. So.
Yeah.
Excellent point and great discussion. And Steve, I knew you'd pop in when we started talking about manure. You're an expert in that spit. So, hey, one more question. Let's talk about the price projections for the next quarter and the formula you're basing it on, please. Bob, again, we'll start with you.
I happen to have those here at my fingertips, as you know I would always. So, all right. So, pardon me for not viewing directly into the camera on my big screens here. So, we're going to go through. This will be a CME equivalent, carcass equivalent basis. First quarter 82.50, that would be compared to 81.90 a year ago. Second quarter April June, I have 91. That compares to about 100 a year ago. Third quarter, I have 87.50. That compares to about 92 a year ago. And fourth quarter, I have about 73 compared to about 75 a year ago. And just to kind of flesh that out just a bit without taking up too much time, part of that revolves, especially for the second half, my disappearance numbers for the second half, which includes exports, are for the July SEP 2022, I'm up 4.5% from a year ago. And for October, December, I'm up 1.5% from a year ago. So we've seen this decline, of course, in the West Pacific pork exports, but an increase in the Americas, exports to the Americas, which is really hopeful and helpful. But again, the decline in China just had not been offset and probably won't be in the coming year.
Thank you, Bob. Great point. What's the formula you're basing your prices on?
Well, again, that's That's CME equivalent. Is that
Okay.
what you're asking?
Yep, got it.
Yeah, okay.
Thank you. Dr. Plain.
Yes, I'm forecasting Iowa, Minnesota base carcass price for negotiated sales. So it's going to be consistently under Bob's numbers. Anyway, first quarter of 2022, $69. Second quarter, 82. Third quarter, 83. Fourth quarter, 68. Works out to about a $75 average for the year.
Thank you,
And
Ron. And Dave.
Ron, that's live weight, right?
No, that's carcass.
Oh,
but
carcass? Oh, okay.
It's negotiated price.
Okay, all right.
And mine would be carcass price national weighted average is the series I was looking at. And for the first quarter, I'm in a range of, I follow the USDA model. I give you a range rather than a number, 83 to 86 in that first quarter. And that compares to 75, 79 a year ago, 88 to 92 in the second quarter, comparing to 104 a year ago, 88.92 for the third quarter, compared to 99, 68 a year ago, and then 78 to 84 for the fourth quarter. And that compares to, I think the current number is right around 78.
Well, gentlemen, it's great to see you all. Thank you so much for spending the time with us today and sharing your insights. I'd like to say thank you to all of our listeners and the attendees, and wish everyone a very Merry Christmas and look forward to a happy and prosperous 2022. Happy New Year.